guys, we're good to go straight to Scott Bauer, CEO of Prosper Trading Academy, because I want to hear what he's looking at right now in markets areas. Scott, appreciate it. Let's get right into the way you're looking at S&Ps right now. Ugly session, Scott. Hopefully, if there's a fiscal deal that comes through, stocks pop. If not, then the narrative is basically totally, thrown apart now. So how are you looking at stocks, S&Ps?
It is ugly. Same kind of deal that we had on Friday, where you didn't want to see the massive sell-off maybe going into the close of the market here. We wanted to see a calmer sort of close, whether it was, biased to the downside or not. We wanted to see it a little bit calmer. So, if we don't get that stimulus tonight, we could drop another 5% tomorrow. But I'm looking at a strategy in SPY similar to what Tom White was just talking about, a put selling strategy, but something that gives you actually about 3 to 4 times the amount of potential credit than just selling a naked put for not taking any further risk.
Okay.
So
walk me through this. You got 3 different legs to this, and quite a bit. You've got 3 contracts in the part you're selling.
Right. So it's like a butterfly spread, except we are naked one put. So instead of this being equal amount of buys, equal amount of sells, we have one extra sell. So right here, my strategy is buying the SPY April 3rd 210 strike put. So below the market, selling 3 of the 195s and buying 1 of the 185. So essentially, it is a naked put strategy. Here's the big difference, Oliver, between doing this and just selling a lower strike put if you want to get in and lower your cost basis. I can do this, collect about $1.75, $1.80 or so. My break even is 185. Okay? If I were to go in and just sell that same 185 strike put alone, I'd get about the same amount of credit, trading about $1.80 to $2 right now. However, the big benefit to this, and hopefully, I'm able to walk through this and people will understand this. The big benefit to this is if SPY continues to go down and closes somewhere in the 190 to 205, 210 range on April 3rd, not only am I going to get that credit that I first sold of $1.80, $1.90, whatever it is, this thing can explode out to about $10. You can't get that by just selling a naked put. There is no more risk to this strategy than there is to selling a naked put. However, the potential upside is 3, 4, 5x what you could get.
It's really interesting, Scott.
I know it's confusing. I know it's confusing.
Yeah, you got 3 strikes between 185 and 210. And you're long the puts to the downside at 210 and 185, selling the 3 at 195. So you get to take in the cash right now, the credit that you collect. But to your point, I think what's really interesting here is because you're selling those 3 195s, that means that even though you own the other 2 legs of this that are long on the short side, or rather I should say you're long the puts and they're short the S&Ps, that if suddenly there's a big rip, you're in pretty good shape too.
Yeah, if there's a rip up, like Tom was explaining earlier with NVIDIA and some of the examples, if there's a rip up, I just get to keep my initial credit. No harm, no foul, I keep my credit. But the great thing about this is if SPY or whatever stock somebody wants to do this strategy in continues to go down, you can make 2, 3, 5, even 10x that initial credit.
Very interesting. So you've got the bearish coverage, but still a buffer to the upside too with the initial credit you're taking in. Scott Bauer, really interesting. Getting creative down there. I like it. See, we all get inside. We can't go out anywhere, and suddenly our creativity starts, reaching new heights. Scott, appreciate it. Always good trades here. Really like it. Looking at the S&P 500.